We're going to start with a slate of all-time highs on Wall Street. Now, the major averages hit record highs. That's happening almost every day. Investors digesting yesterday's Fed rate cut. Earnings still look good, blah, blah, blah. The NASDAQ up about 1%. But it was the small-cap Russell 2000 leading the gains. It rose more than 2.5%. And you may not know this, but the index setting its first record close since November of 2021. Interestingly, though, rates actually were up. The benchmark 10-year yield went higher, not lower. In fact, at one point today, it hit 4.14%. Yesterday's very brief drop below 4% seems long forgotten. But Appaloosa Management president and founder David Tepper, also the owner of the Carolina Panthers, urging caution, telling Squawk Box this morning we could all be headed for dangerous territory.
To go too much more on interest rates, depending what happens with the economy, it gets into the danger territory. Right now, to go another 25 basis points or another 50 basis points, does it really matter? One way or another, it probably keeps the stock market a little buoyant. You have to be careful because we're, like you said, where the average stock isn't cheap. The big stocks are not cheap.
Guy Adami.
Hello, Brian.
So I won't use the term basis point except to say that I'm not going to say basis point. Let's talk 1/4%, 0.5%. Is David Tepper correct?
First of all, it's great to have you here. I'm sure Tim greeted you last night.
I did, but we can do it again.
Well, why not? Because he's here again.
You're
tonight.
back. You should do it. So.
Hello, Brian.
Hi.
Number two, that's about as dour as you're going to hear David Tepper. So when he has that type of tone, listen, I don't think he's saying you sell everything today or tomorrow, but when he's somewhat cautious, which you really haven't heard him be over the last decade or so, I think you have to take note. And what I think he's speaking to is, the Fed's sort of in the rearview mirror. Another couple cuts are probably not going to move the needle that much, but it's hard finding value right now, and the market has gotten itself expensive. So when I listen to him and I hear the tone in his voice, to me it sounds somewhat cautious for the first time in a while.
Well, he was really balanced, and he talked about a lot of things. He even talked about his politics, and he said he's right up the middle. And that's what I heard in terms of his market view. And what I hear, what I think you're saying, what I think the market did today, when you see all four indices close at all-time highs, but you've got the high growth, very expensive NASDAQ, but maybe you're paid for that growth, finishing, and then small caps rallying. You've got kind of a barbell strategy. You've got people saying that's a glass half full interpretation of the Fed saying, yeah, we're certainly in easing mode, 2, 5, how many cuts, but the economy's not falling apart. Jobless claims today, a volatile data point, but nonetheless showed that jobless claims fell. That gave the market a little more ammunition to say the labor market's not so bad. So my summary on all of this is, sorry, Guy, hold your ears. Yeah, this is Goldilocks. You've got Fed in easy position, and you've got an economy that's not falling apart. Even if stocks are expensive, you're buying equities in that environment.
Yeah, I guess you are, unless yields start going up, right? And so when you think about
which they did today.
Well, they did a little bit. Last year at this time, we had that jumbo cut, 50 basis points. The 10-year was trading at 3.7% or something like that. Went all the way to 5% or so over the next, 3 to 4 months. And so you've seen a big divergence over the last, call it, couple months where the S&P has just kind of blown out to new highs, and you've seen yields on the 10-year go the opposite way. If you start to see yields maybe work their way up to 4.5, where they were just, 2 months ago, that might be cause for the S&P 500, at least investors, to kind of take their foot off the pedal a little bit. And I also say that, we see this rotation in the Mag 7. It happened when we saw Google, when we saw Amazon and the like. Now you're starting to see these names kind of underperform these moves. NVIDIA has never confirmed the new highs in the S&P or the NASDAQ. And we're starting to get kind of, long in the tooth. You take this NVIDIA investment, I know we're going to talk about it later. It feels like we're trying to pull lots of rabbits out of hats. And I'm not saying that is by design. The SOX massively outperforms today for something that is not going to be really relevant to the technology complex for a while, at least 6 months, maybe a year.
Yeah, look, our call on the market has been we like stocks into next year on kind of a 12 to 15-month view. We put out a 7,100 target earlier this week for the second half of 2026, but we kept our target low for this year. We nudged it up a little bit to 6,350, but that's lower than where we are right now. And what we're trying to reflect, what the message we're trying to communicate there is we do think we need a period of digestion. We think that this kind of workhorse part of the market is hitting valuation ceilings. And when we look at the broadening trade, I understand understand people want to get bullish on rate cut bets, but I've been hearing about that for months. And if you look at the small caps, they're not expensive. They're not cheap. They've been under-owned, but the valuations have already crept up.